Hello everyone. I hope you and your family is doing well. My name is Siddharth Srivastava and I'm head ETF products at Mirae Asset Mutual Fund. Today I'm here to talk about a new product which Mirae Asset is coming out with, and it will track the S&P 500 top 50 index. When we talk about US markets, there are two predominant way from a product strategy point of view to take exposure. One is that you invest in a tech-centric portfolio or a sector-centric portfolio like a NASDAQ 100, or you invest in a sector-agnostic manner. By sector-agnostic, I mean that your portfolio is not sector-biased in nature. Now, the tech-centric product will typically give you high returns. It has given that in last 5-10 years, but it comes with a higher volatility, higher risk. Whereas the sector agnostic portfolio may give you, let's say, a bit lower returns, but it comes with a lower risk. And that is what we are trying to achieve with this fund. The S&P 500 top 50 index consist of 50 mega cap companies which are listed and deemed to be domiciled in US from sectors across board, ranging from IT to consumer staples, from consumer discretionary to financial services, from energy to industrials. These mega cap companies are one of the most well-known companies globally. We may very well be using them in our daily life, or if not, we are very much aware of them because they are setting benchmarks for others to follow. So on the tech side, for example, it consists of companies like Apple, Microsoft, Adobe, Cisco, etc. Whereas on the healthcare side, it consists of companies like Pfizer, Abbott, Johnson & Johnson. In media and entertainment, it consists of companies like Comcast, Disney. Whereas if you look at financials, it consists of companies like JPMorgan, Wells Fargo, Berkshire, Hathaway. The idea and intent of this product, as I mentioned earlier, is to provide an exposure to all these wonderful sector-leading companies through a single portfolio in a sector-agnostic manner. And this index has evolved and will evolve as the US market evolves. So one of the very good properties of a sector-agnostic portfolio and a portfolio like S&P 500 top 50 is that, for example, in 2005, the market was financial service heavy, rather the segment was financial service heavy, and financial services had 20% representation in this portfolio. In 2011, after global financial crisis, that came down to 14%, whereas IT increased from 19 to around 22, 23%. Whereas right now, when US is dominated by tech companies, we are seeing IT has a weight of around 38%, and consumer discretionary has a weight of 13%, whereas financials have gone down to, let's say, 8%. It also has very healthy representation of healthcare at 12%, energy at 2%, and other sectors also. So we can very well say that this is like a Nifty 50 of US, right? And in terms of performance, it has done really well. In fact, in last 10 years, it has outperformed Nifty 50 by 10.1%. And in last 2 and 3 year period, it has also given double-digit excess returns over Nifty 50. So for a person who wants to take exposure in global markets like US, this can be a very good fund because, as I mentioned earlier, it is delivering alpha over domestic market in the long run. And in order to do so, it is investing across sector in sector leading companies so that the overall risk of the product is also lower compared to tech-centric products like NASDAQ 100. Now, to invest in global markets, the investor should first look at his risk profile, right? Because a person who has higher risk profile should invest in global products. Because while wealth creation is one of the core reasons why people want to invest in foreign markets, apart from diversification and earning more returns due to depreciation in INR, but it also comes with additional risk, right? Because if you're investing in US market, you will be exposed to political and regulatory landscape of United States. You will also be exposed to how US market is behaving. So it is very important to analyze your risk profile and understand what the risk profile of the product is and what the intent of the product is. So in this case, if your risk profile, if from a risk point of view, you are okay, then you can very well explore this particular offering from an investment point of view. And or on the other side, if you are already invested in, let's say, a tech-centric portfolio like a NASDAQ or a FANG, you can use this product or invest in this product to have a complementary exposure in a product which is more diversified and has lower risk. So from a taxation point of view, any scheme which invests in foreign markets gets taxed as a debt-oriented scheme. So for holding period less than 3 years, it is your personal income tax rate slab which gets applicable. And for holding greater than 3 years, the taxation is 20% with the benefit of indexation. And indexation plays a huge role, and it in a way benefits the investor. So you should, anyways, from a taxation point of view, look for investment horizon of at least 3 years. But as we all know that whenever you talk about equity markets, you talk about investment from a long-term point of view, and that is probably more true when we talk about global investing. And whenever you're investing, typically you should look at a 5-year to 7-year horizon. The NFO opens on 1st of September and closes on 15th of September, and you can invest in this NFO through Groww platform. The scheme reopens for ongoing subscription from 23rd of September. We hope for your participation in this NFO. Happy investing. Take care.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing. Please read the risk disclosure documents carefully before investing in equity shares, derivatives, mutual fund, and/or other instruments traded on the stock exchanges.